Hey everyone, it is Evan here from the Trade Risk on Saturday, October 27th, here with a weekend market recap video. We're going to cover all of the major markets, the current market environment, and then finish off looking at some sector analysis. Getting this video out a day late today. I've been down in San Diego at Stocktoberfest. It was an awesome event as always. Stocktwits and Howard never disappoint. Plenty of booze and probably not enough content, but that is the fun part about these events, and it was some great time, had some good conversations, and look forward to next year. So let's jump into the charts here. It was another very volatile week in the markets overall. We're going to spend a lot of time on the S&P 500. This really is broad strokes though for all of the major US averages. First things first, we have 3 out of the 4 major US markets now in red territory for the year. So everything but the NASDAQ is now negative on the year. And while that's not necessarily, it does have some implications. It's not super significant from a technical perspective, but it is certainly ingrained in many people's heads now when the major averages have suddenly gone negative like they have. When we look here at the S&P 500, we can see we have fallen very fast in short order here. This is a weekly chart. You can see we're down 4% on the week this week, and we took out the lows that we made back on the 12th of October. So we had this violent first initial hit to the markets back on the week of October the 12th. We saw this little bit of a pop here last week, but still an ugly close. We didn't close near the highs of the session, but it was an inside week, and then we very quickly resolved last week and the week before to the downside, and again increased in volume and saw volatility continue to expand. So we're seeing really just this bearish trajectory here really take place, significant volume coming in, expansion in range. These are bearish characteristics here. Again, doesn't mean that it has to be end of the world doomsday. In many respects, this is sort of healthy price action. It's just that we haven't seen it in such a long time. And when I say healthy price action in the respect of sort of long-term trends, markets, pullbacks, 10%, 15%, 20% off highs, these things do happen. It just is always scary when it finally gets here. So when we look at the S&P 500 now, if we zoom out on this chart, this is a weekly time frame. This long-term trend that extends from the 2016 lows, that has now been broken to the downside. We are very comfortably below it right now, which is really around that 2800 level. So that's about 140 handles higher than where we are right now. And when we look here towards the next big levels to pay attention to, I'm going to switch it to a more busy chart here where there's a lot more horizontal levels panned out here. And really, when we look at some of the past levels that have held the influential inflection points in the market, we really have about this 2590 area, and then we have the year-to-date lows that we made in February very briefly down around 2532. So if we look at where we close now to the year-to-date lows, that's approximately 4.6% further of a sell-off. That would bring us to nearly 15% off of the all-time highs we made just last month. So really, when we look at this here, that would give us a 15% correction to retest the lows of the year. And at this point, while I certainly, again, will never speak in certainties or make any bold calls, it does not seem unreasonable to start to at least get down here and test this 2600 and even the year-to-date lows. I think that's a reasonable spot now, given the amount of selling, given kind of the panic that we've created in the market. And really, though, we haven't seen a super, a big flare up here in the VIX. When we look back in February, notice how high we got. I know, of course, we had a lot of volatility blow-up related products that helped fuel this, but we were north of 40 briefly, and really saw some good fear kind of creep into the market there. And right now we're about 20-25. So again, it's certainly elevated, and it speaks to the ranges that we're seeing. But to see a real more convincing washout would be something north of 30, I would suspect, here in the VIX. Certainly, again, doesn't have to happen. What the alternative would be, instead of some very fast, hard, single-day capitulation event, is just a more slow consolidation through time. Let support build in. If the market moves sideways, say above 2,600 to 2,700, and we build out a multi-week, even multi-month sturdy base to show that buyers are in fact showing up here and starting to accumulate and dip their toes back into stocks, then we may never get that 30 handle or higher on the VIX. It may just be a slow kind of grind accumulation through earnings and through the end of the year. That's certainly a possibility as well. So there's lots of different outcomes here. The bottom line is volatility so far is here to stay, and hopefully by now you've made some adjustments to your position size or risk management, or you've dialed it back, or you're in cash. Those are all good things. Intraday trading right now, that is where I would say that the edge is. There's no overnight. The overnight risk is high. If you are intraday trading now, ranges have expanded. There's more volatility. The indices are in play. You don't have to hold stocks overnight. I'm not a day trader. Don't necessarily advocate people do that. But I think now's the time where taking some shots intraday. And if you're going to be overnight, then you just want to make sure you're very mindful of that position size, and you understand that risk is to the downside now, and those nasty gap downs can certainly happen in these types of environments. So all in all, I think that covers the broad strokes here. It's volatility and risk on right now in markets. We're heading lower. We're going to see violent bounces along the way, but we want to see at least hold above the past couple of days highs, really taking out a prior week's high. I think that's going to be a good first step. So if you say, when is the selling over? Well, at least let's get back above a prior week's high. And at this point, that would be all the way up at 27.78 or so, or 27.79. So that's, probably not going to happen in very short order. This is something that, again, I think will either take time or require a very single day high capitulation type of event. So that pretty much covers there the S&P 500 levels on the downside, 2590, this general area, 2600, 2590. We found some structure and lows there back in April and a little bit in February. So keep an eye on that. And then ultimately the year-to-date lows, 2532. On the upside, 2800. That's what I'd like to see us getting above. Last week's highs, or approximately this 2800 level. That is where I would start to respect the bull's effort if we can get back above there. So that's the S&P 500. Really kind of echoes pretty much across all of the major averages. The Russell 2000 here, almost back to its year-to-date lows. In fact, I think well, let's open it up. I think it was right here. So it was 142.50 was the year-to-date lows in February. You can see we're actually quite close to that, which tells us that, yes, the Russell 2000, which is nothing new, has been selling off a little more furiously than the others. It's a little over 3% from current prices are the year-to-date lows. So I know this is a busy chart. There's lots of lines here, but just like the S&P 500, if we look at all of these horizontal lines that we have in there, and again, we don't expect that they're magic levels that the market has to respect, but there's really, when as we're selling here, it's just it's that hot knife through butter. There's absolutely just total disrespect for any of these prior horizontal levels, and that again just tells you that you're in a sort of bear market on this time frame, right? I don't care about the definition of what a bear market is, but on terms of this daily chart here, we are in this bear trend to the downside, and it's very steep. And again, we'll probably see some snapbacks on the way, but I'd like to see us at least getting back above a weekly high. That would start to give me some confidence, or some, at least indication that bulls are trying to stabilize and trying to reclaim their territory. Finally, the NASDAQ 100. This is the lone major average now, the NASDAQ Composite. This is the NASDAQ 100, but the NASDAQ Composite is still green on the year by about 3% or so, so it's still holding out. When we look here at the weekly chart, arguably, the volume has been tremendous over the past 3 weeks. Just looking here on the weekly chart, this selling has come on very, very heavy volume, but we haven't seen a tremendous washout yet here. We are broken down from this 2016 trend, again, depending on how you want to draw this. We are starting to take that out to the downside after the close of this week. week. So we do have very similar kind of prospects here on the longer term time frame. That risk is to the downside, and that when we look back at these prior big levels to pay attention to, 152, that is approximately the lows of the year. I think the lows of the year actually were 150, just over 150, but down in here were the lows that we saw back in February, a little bit of structure in April. And if this sell-off continues, if volatility is here, then these are some big levels that, again, I'd pay attention to potentially retest and hope that they hold. So that covers, I think, everything I wanted to talk about there for the major averages. Let's get into some of the other major markets now. We'll go to TLT, which did finish higher this week, 1.13%. The safety haven asset of long-term treasury bonds is holding true so far. We are still below 117, so I do still want to remain very suspect here. I wouldn't feel super comfortable being involved, being a buyer right now below this 117 area, but it so far continues to work. It's a better spot to be than equities as of the last couple of weeks, but just be cautious. That longer term structure is not necessarily your friend at this point. Gold here also continues to act as a little bit of a safety haven, 0.66% to the upside. Good volume coming in. We're still holding this trend. We're still holding above 115. Nothing's changed there. Longer term structure still, again, questionable here in gold, but in the short term, it is being bid because, quite frankly, there's not much else. There's not many other places for money to rotate to right now. Silver, very similar to gold. It was up 0.5%. Again, still kind of developing, what looks like, especially on this weekly chart, just a bear flag here after a ugly breakdown throughout June, July, August. It is holding up right now in the short term, so we'll give it some credit where credit is due, but let's just pay attention to the longer term time frames if you are playing in that sandbox. Finally, we'll look at, let's see, oil here. If we go to the weekly chart, it is hitting some pretty big levels in terms of support, or at least on this trend line level. If you want to use this year-to-date slope here for basically the start of January to where currently prices are trading, you can see we did kind of rebound off of that this week around this $14 level. We've been holding up through here. It is still arguably in this same structure. So if we did see buyers step in here, that would be pretty much business as usual as we've seen throughout the course of this year. So if you are a bull here in oil, I'd say around this $14 area in the USO ETF, and then all the way down to 13. Those are levels that you want to see held. Natural gas, on the other hand, is acting a little bit more resilient here. Nice little reversal day on Friday. This is a name that, this is not a name, this is a ETF here for natural gas that we are paying attention to, and one that we might be placing a trade into or getting involved in on Monday, depending on how this acts. But we like the reversal here. We like the basing out pattern up here. We tried to break down or gap down earlier in the day. Bulls stepped in, closed us strong. So this might be in play for us next week. But natural gas holding up well and continuing to try and hold up in the face of a lot of pain throughout the rest of assets. So those are all of the rest of the major averages there and major markets. Let's go to some of the sectors now that are performing and not performing this week. Everything was red this week, even the safety haven trades of staples, for example. This was the best performing of the sectors, but it was still down approximately 1.5% here on the week. You can see it is in a heavy congestion spot here, 55.50 or so. That was kind of a prior inflection point. It was almost the peak of this rally here in August and in September. We reversed off it this week, and we closed down here near the lows. So depending on how close you're looking at this, I do think staples largely are still holding up well. There are still names that are bucking the trend, that are grinding higher. That relative strength is continuing to increase. So if you are participating, if you do want some of that equity exposure still and you're trying to eke out some gains, I do think the staples and some of the defensive areas of the market are still the best game in town, but clearly they still are not resilient or not ignoring completely the weakness out here. It's down 1.5% for the staples. Utilities, kind of similar situation here. It looks like it's comfortably kind of moving sideways. It's in a kind of a choppy area right now. So individually, there are still REITs and different utility plays that are holding up well. So once again, if you do want that equity exposure, I would say you should be keeping an eye on this sector of the market, down 2% though overall. Next up, we have technology here, which was surprisingly holding up in the top 3 here, probably earnings related, but essentially 2.74% on the downside this week. If we look here at the structure of this trade, it looks very similar to the Qs. It is still kind of holding up for a risky area of the market. It hasn't completely given up, all the way back down towards the lows like some of these other sectors, but it's still not in a comfortable spot to be. This is not necessarily encouraging price action. The one slight encouraging thing would be that we did bid off the lows and managed to close right at the 10-12 lows here at $68. So there is some indication here that we are trying to stabilize, but I'd still want to be quite cautious there and position size accordingly if you are participating there. On the downside, on the worst performing sectors, we have energy, which got completely hammered, continued to get hammered this week, 7% on the week to the downside, right back to or very close to the 2018 lows here. Very wide swings in energy. If we go down to the daily chart, you can see just a gap down, and there's just zero floor here in the market. It just has completely sort of evaporated and taken out lots of market cap for XLE. Certainly stretched to the downside. It's a tough short, it's a tough long, it's just basically an avoid, but there is plenty of structure here. If you're looking for some type of rubber band trade, if you're very tactical, then I could understand around the $65 area to look for some type of bounce there. IBB, kind of similar situation. It's down almost 7% this week. Really ugly, but it's slamming down into this very, very important support. This has held all year. In fact, year and a half now, this $100 level. If we go to a weekly chart, you can see there's just been lots of buyers stepping in around this $100 level. We've made a very quick drop down from the 120s all the way down to the 100 or so. It's already 18% off of the highs. So again, if we're super oversold into a significant area like this, then if you're tactical, if you're active, and if you are experienced, then maybe you're looking at some shots around here. But again, know your risk, because this is a very volatile, higher beta area of the market. Finally, industrials taking out and making new year-to-date lows here. Really ugly for XLI. If we look here now on the year-to-date chart, so this is a yearly chart now of XLI. This is down almost 9%, the industrials ETF, and giving back almost half of last year's gains and rally. So some pretty ugly price action there. Yes, again, it is oversold for sure. We are back into some structure here from 2017 August levels. So maybe this gets a little bit of a snapback next week. But quite honestly, again, you have to just understand that you are in sort of a free fall type of market right now. There's opportunity if you are experienced, and again, probably best on the day trading side of things rather than holding stuff for that overnight risk. So that is the market out there. Lots of ugly things. Hopefully you guys have been protecting yourselves and aren't getting too flipped around in this type of environment. It does look like it's here to stay, but I'm sure there will be opportunity as volatility in the VIX remains north of 25. There's going to be opportunity in both directions. Just have to make sure you don't get chopped up trying to take advantage of it. So easy, always best or always easy as a default to raise cash because cash looks pretty good when things are falling 4%. Major averages are falling 4% on a week. Then your cash position looks like a mighty fine and smart decision. So there's nothing wrong with kind of stepping aside and letting the market stabilize and do its thing. So that's it. Thanks so much as always for tuning in and listening. You can subscribe on our YouTube channel normally Tuesday and Friday for the market recap videos, trade ideas on Wednesdays. Have a great weekend, and I'll talk to you guys next week.